We have an excellent question here from Mazia, who has a question about gold's recent movements, saying that if we take a look at gold, barring, of course, the move that we've had to the upside in today's session, barring that, we have seen gold prices being very pressured over the last couple of weeks. And Mazia wants to know that as gold is seen as an inflation hedge, why hasn't it moved higher alongside inflation expectations? If we take a look at inflation expectations, this is the in purple and light blue, we have the 5 and the 10-year forward-looking inflation expectations for the US. So seeing that gold is an inflation hedge, the question then, why with that in mind, haven't we seen a stronger move to the upside in gold prices? So thanks for the excellent question, Majia. And I'm going to run through the answer for gold specifically in the video, but I also want to use it as an opportunity to touch on another topic when it comes to our trading, and that is our natural tendency to fixate on one thing instead of many things at any given time. And this is a really very common thing for traders as well, and something that I often catch myself doing when looking at the market or looking at a particular asset. And you see, from an early age, we've been taught to problem solve. And obviously it's a fantastic skill to have, but in our efforts to try and solve a problem, it often causes us to fixate on one thing that's in front of us, one challenge that's in front of us, by looking at it more subjectively instead of a bigger picture view or a more objective view. So what does that have to do with the question about gold prices and inflation expectations? Well, you're absolutely right that inflation expectations are very important as a driver for gold prices, as gold is considered as an inflation hedge. However, even though gold is considered as an inflation hedge, it's not the only driver that can or will affect gold's price. So gold is also seen as a store of wealth. It's seen as a safe haven. It's obviously a precious metal. It's seen as a currency of sorts in terms of how it trades. It's seen as a commodity, obviously. So there's always going to be a numerous amount of factors and drivers that can influence the price of gold. And it's not only gold, of course, many other assets that we are trying to trade will have many different or multiple drivers. And arguably for gold, with its many different hats that it can put on, there might often be a lot more going on compared to just, a regular or another asset. But the point is that there's always going to be multiple factors that we need to keep in mind that can influence the price in the short term. So for gold, as an example, even though it is expected to move in tandem with inflation expectations, due to it being an inflation hedge, it's also a commodity, right? So it's going to have supply and demand dynamics as well. As a commodity, it has that traditional inverse correlation to the US dollar as well. As a store of wealth, as well as a safe haven, it has a traditional strong inverse correlation to real yields, as you know, which means that any big fluctuations in something like nominal bond yields is going to be very, very important for gold as well. As a safe haven, any sudden changes in risk sentiment will be an important factor as well. So arguably, the biggest driver of all of these will always be real yield. So if we take a look at gold versus real yields, we have that very strong traditional inverse correlation between the two. So that's always going to be your that driver that gold will be more sensitive to than others. So any sudden changes that we see in something like nominal bond yields on the US side, that's going to be arguably one of the biggest drivers for gold. But gold sensitivity to something like the dollar, to risk sentiment, to, like you said, inflation, to supply and demand, it can really vary in many different degrees at any given point. So there can be multiple factors that drives it and pushes that acts basically as a push-pull factor for gold at any given stage. So as per the title of this video, just like in life, it's never just one thing. It's always going to be a combination of things, which desires a more objective approach in the way that we view certain price fluctuations. You'll often see financial articles or television shows, trying to find one talking point, one narrative, and just fixate on that and attributing everything that's happening, to just that very one thing. And yes, of course, sometimes it might be one thing, one event that creates ripples across the market. That's certainly a normal occurrence, but it's always going to be the case, and oftentimes it's a whole list of intertwined and interlinked factors that's driving particular asset prices. And a good tip that I've always trained myself to do is making sure that I'm always broadening my knowledge of the various asset classes that I'm trying to trade, so that when I do see a huge price move in either direction, that I have a sort of mental checklist that I can run through to find a possible root cause for that particular move. And sometimes you won't be able to tick any one of the boxes in your checklist, to find that root cause. And in those times, it's best to take things easy and wait for some clarity on the reasons for the move. So in terms of the inflation expectations, right, seeing it pushing to the upside and not seeing gold budge on the back of that, immediately ask yourself what's happening to the dollar. Immediately ask yourself what's happening to equities in terms of risk sentiment. Immediately ask yourself what's happening to real yields in terms of nominal yields on the US side. So if I ever see a massive spike, for example, in gold, if it's tanking or ripping, I immediately look at equities to see if it's risk stance. Immediately look at the dollar to see if it's that. Immediately look at bond yields to see if it's that. Then looking at inflation expectations to see if it's that. And if I can't find a cause in any one of those markets that might be the reason for that, then I look at the technicals to see if it might be a breach of a key level. Maybe some stops were taking out at a key level, and that's causing a little bit of a flush. And after all of that, if the move doesn't make sense, then I just don't engage the market. But it's very helpful to build that repertoire of knowledge to know that what type of things might be affecting different asset classes at different times. And then when you see those things, you can basically just run through that checklist, that mental checklist, saying that is it this, is it that, is it this, is it that? And if it's none of the above, then obviously you can just ignore the move. So I hope that it helps with the question. I know it was a little bit more than just the question on gold and inflation, but I thought it did provide us with an opportunity to touch on a broader topic as well. And as always, please, if there's any other questions, don't hesitate to let us know.